Most people think inflation is an accident, a mistake, a policy error, a temporary shock. They blame oil, supply chains, corporate greed, pandemics. Each explanation feels reasonable, and that's the point. Because every one of them implies something went wrong. That inflation is a malfunction. It isn't. Inflation is not the breakdown of the system. It is the system functioning under pressure. Modern economies are built on debt, not savings, not surplus, debt. Governments issue bonds. Banks extend credit. Central banks provide liquidity. Growth is not optional inside this structure, it is required. Because debt carries interest, and interest must be serviced. If the economy stops expanding, the math tightens. Defaults rise. Banks weaken. Leverage cracks. Asset values fall. That is not theoretical. It is mechanical. So when growth slows, there are only a few choices: raise taxes, cut spending, allow widespread defaults, or expand the money supply. Three of those are politically painful. One is subtle: monetary expansion. When central banks expand liquidity, it isn't framed as currency dilution. It's framed as support, stimulus, stability, emergency measures. The language is protective, never direct. But increasing the supply of money without increasing real productivity changes purchasing power. Not immediately, not evenly, but structurally. New money does not enter the system everywhere at once. It moves through financial channels, bond markets, large banks, institutional balance sheets, asset purchases. It enters at the top. Those closest to the source deploy it first. They buy assets, they refinance debt, they leverage positions. Prices begin to move. Stocks, real estate, financial instruments. By the time that liquidity filters down to wages, the adjustment has already happened. Inflation is often described as rising consumer prices. That's incomplete. Inflation is a transfer mechanism from savers to asset holders, from fixed wages to leveraged balance sheets, from cash to capital. If inflation were truly accidental, it would not consistently reward those who own appreciating assets. It would not consistently erode the purchasing power of stored cash. It would not consistently reduce real wage growth over long cycles. But it does, across decades, across administrations, across economic regimes. That consistency is not random, it is structural. In a debt-based system, moderate inflation is useful. It reduces the real burden of outstanding debt. It inflates nominal GDP. It supports asset valuations. It stabilizes leveraged institutions. Deflation does the opposite. It increases the real cost of debt. It pressures banks. It triggers defaults. It exposes fragility. When forced to choose between price stability and systemic stability, the system protects itself every time. Inflation is not chaos. It is a pressure valve, a slow recalibration, a silent tax that requires no legislation. And because it moves gradually, most people adapt behaviorally before they question it structurally. They notice groceries rising, rent climbing, insurance increasing, but they still assume something went wrong. They rarely ask whether currency dilution is embedded in the architecture itself. In a system that requires perpetual expansion, money supply cannot remain static. And when supply expands faster than productivity, purchasing power declines. Not overnight, not explosively, but persistently. This is not an accident. It is design under constraint. The real question isn't why inflation appears, it's what kind of system makes it necessary. To understand inflation structurally, you have to understand how money is actually created. Not printed, created. Most people imagine physical currency, bills rolling off a press, stacks of paper entering circulation. That's cosmetic. Modern money is digital, and it is born through debt. When a commercial bank issues a loan, it does not transfer existing money. It creates new deposits. The borrower receives newly created purchasing power. The bank records an asset, a loan receivable. Money enters the system the moment debt is issued. Every mortgage, every corporate loan, every government bond purchase expands the monetary base indirectly. Now scale that. Governments spend beyond tax revenue. They issue bonds. Investors buy them, or central banks buy them. When a central bank purchases government debt, it credits the banking system with new reserves. Those reserves support more lending, more credit, more expansion. This is not theory. It is balance sheet arithmetic. On one side of the central bank's balance sheet, government bonds, mortgage-backed securities, financial assets. On the other side, newly created reserves. No taxpayer vote, no legislative inflation bill, just accounting entries. The system expands quietly. This is where inflation truly begins. Not at the grocery store, not at the gas pump. It begins on balance sheets. When liquidity increases, capital searches for yield. It flows toward assets that can absorb scale. Equities, real estate, private equity, infrastructure. Asset prices respond first because capital markets adjust instantly. Consumer prices adjust later because wages move slowly, contracts lag, behavior adapts gradually. This sequencing is critical. The first recipients of new money deploy it before prices fully reflect the expansion. They acquire assets at yesterday's valuations. As liquidity circulates, valuations rise, balance sheets strengthen, collateral expands, which allows more borrowing, which allows more asset purchases. Liquidity fuels leverage. Leverage fuels asset inflation. Asset inflation expands collateral. Expanded collateral fuels more liquidity. It becomes reflexive, self-reinforcing. Meanwhile, wage earners negotiate salaries annually, or less. Savings sit in accounts earning below inflation. Fixed incomes remain fixed. By the time consumer price indices register pressure, the asset cycle is already well underway. This is why inflation does not feel uniform, because it isn't. Financial assets inflate first, consumer goods follow, services adjust later, and those without appreciating assets experience the final stage without benefiting from the first. When people say the stock market is disconnected from reality, they misunderstand the mechanism. It is not disconnected. It is first in line. Monetary expansion is not sprayed evenly across society. It is injected at specific nodes: banks, treasuries, institutional markets. From there, it diffuses outward, losing purchasing power as it travels. By the time it reaches rent, groceries, tuition, insurance, the currency unit has already been diluted. What feels like rising prices is often declining currency strength. This is why central banks rarely fear moderate inflation. It supports asset markets. It reduces real debt burdens. It sustains confidence in nominal growth. What they fear is deflation, because deflation contracts balance sheets, shrinks collateral, exposes leverage. And leverage is everywhere. In a leveraged system, liquidity is oxygen. Inflation is the side effect. Remove the oxygen, and the structure suffocates. So monetary expansion continues, not recklessly, not randomly, but structurally, because the alternative is contraction, and contraction is politically and financially destabilizing. Now the pattern becomes clearer. Inflation is not simply about rising consumer prices. It is about where new money enters and who receives it first. And that leads to the deeper asymmetry. Not everyone is positioned the same distance from the source. Some stand near the valve. Others feel only the pressure. If this feels familiar, if you've felt this pressure but never had words for it, this channel isn't here to motivate you. It's here to help you see clearly. If that resonates, like the video. Subscribe. More clarity is coming. Inflation does not impact everyone equally. That sentence sounds obvious, but most people never examine why. They assume higher prices hurt everyone the same. They don't. The distance between you and newly created money determines your outcome. Not effort, not intelligence, proximity. Those closest to credit expansion hold assets. Those furthest hold wages. Assets inflate. Wages adjust. Not at the same speed, not with the same force. When liquidity expands, equities rise. Real estate appreciates. Private capital valuations stretch. Owners of those assets experience balance sheet growth. Net worth expands. Collateral strengthens. That strengthened collateral allows more borrowing, more leverage, more acquisition. Ownership compounds. Meanwhile, wage earners negotiate within fixed structures. Annual raises, hourly increases, limited bargaining power. But prices adjust continuously. Rent updates, insurance recalculates, tuition rises, utilities climb. By the time wages reflect inflation, asset holders have already moved forward again. Inflation rewards leverage. It punishes liquidity. If you hold appreciating assets financed with fixed-rate debt, inflation reduces the real cost of your obligation. You repay tomorrow's debt with diluted currency. But if you hold cash, inflation reduces the value of your stored labor. Silently, gradually, consistently. This is why inflation feels confusing, because official narratives frame it as a universal burden. But structurally, it is selective. Consider housing. When interest rates are low and liquidity expands, property values surge. Owners experience appreciation. Renters experience rising costs. Same market, different position. Consider equities. When monetary stimulus enters financial markets, stock valuations climb. Shareholders benefit. Those without exposure see none of the initial gain. But they still face rising consumer prices later. Inflation is not just rising prices. It is a reallocation of purchasing power, from those who earn to those who own. And because ownership is unevenly distributed, so are the benefits. This is not conspiracy. It is structural math. In a system dependent on credit expansion, asset prices must remain supported. Confidence must remain intact. Balance sheets must remain solvent. That priority shapes policy, even when the language suggests neutrality. When inflation accelerates too aggressively, rates rise, liquidity tightens. but rarely long enough to dismantle asset structures entirely, because large asset deflation threatens systemic stability. And systemic stability is protected. This creates a cycle. Expansion inflates assets. Correction trims excess. Expansion resumes. Over long time horizons, asset ownership compounds. Wage growth lags. Purchasing power drifts. The system does not promise equality of outcome. It amplifies structural position. If you are leveraged into appreciating assets, inflation works for you. If you are dependent on fixed income, inflation works against you. Most people debate inflation morally. They rarely analyze it positionally. But morality doesn't change balance sheets. Position does. This is why two households can experience the same economic environment and live in completely different financial realities. One sees net worth expand. The other sees expenses rise. Inflation is not chaotic. It is directional. It flows toward ownership. It accumulates around leverage. It bypasses liquidity. And over decades, it widens gaps without dramatic headlines. The currency weakens. Assets strengthen. The saver adjusts. The owner compounds. That asymmetry is not accidental. It is embedded. And once you see that, the conversation shifts. The question stops being, how do we stop inflation? And becomes, where am I positioned relative to it? If inflation is structural, then outrage is irrelevant. Complaints don't change architecture. Systems respond to incentives, not frustration. A debt-based economy requires expansion. Expansion dilutes currency. Dilution inflates assets. You can disagree with it, but disagreement does not alter the mechanism. So the only rational question becomes, where are you positioned inside it? Most people try to fight inflation defensively. They cut spending. They save more cash. They wait for prices to normalize. But if currency supply expands persistently, holding idle cash is not neutral. It is exposure. Cash has utility. Liquidity matters. But long-term purchasing power is preserved through ownership, not storage. Ownership of productive assets, ownership of equity, ownership of real estate, ownership of businesses. Assets that adjust with expansion instead of eroding under it. This does not mean speculation. It does not mean chasing volatility. It means understanding that inflation is directional and aligning with its direction. When you hold appreciating assets financed responsibly, inflation reduces the real burden of fixed debt. Your liabilities shrink in real terms. Your assets reprice upward. Time works with you. When you rely solely on wages, time works against you, because wages adjust slowly and prices adjust continuously. The system rewards leverage tied to productive assets. It penalizes stagnant liquidity. That is not ideology. It is balance sheet math. And once you see it, the emotional layer falls away. Inflation is not an accident. It is a release valve in a growth-dependent structure. It protects debtors. It supports assets. It dilutes currency. It has done this across cycles, across decades, across administrations. You can wait for a perfect policy environment, or you can position within the existing one, because systems rarely redesign themselves to favor those who misunderstand them. The saver hopes. The owner adapts. The observer complains. The positioned compound. Inflation is not chaos. It is predictable expansion under constraint, and predictable systems can be navigated, but only if you stop misdiagnosing them. If this changed how you see inflation, If it shifted the question from "Why is this happening?" to "Where am I standing?" Stay here. Subscribe for more structural breakdowns like this. Like this if it clarified something. And watch the next one. We don't chase headlines. We map systems. Because clarity compounds. Excitement spreads quickly. A new startup, a sudden IPO, a cryptocurrency surge, a viral trade. Flash captures attention. But attention is not the same as wealth. Wealth rarely announces itself in real time. It accumulates quietly. The assets that build lasting financial stability are often unremarkable. Utility companies, water treatment facilities, logistics networks, rental housing. They don't trend. They don't dominate headlines. They operate. And operation is what compounds. The financial world rewards spectacle. Spectacle attracts participation. Participation increases volatility. But volatility is not the same as durability. Durability is boring. Consistent cash flow, predictable demand, stable contracts. These characteristics don't generate excitement. They generate returns. A power grid does not need hype. It needs reliability. A water utility does not need attention. It needs usage. Infrastructure serves necessity. Necessity produces recurring revenue. Recurring revenue compounds. This is the quiet advantage. While markets chase momentum, infrastructure collects payments. While traders react to headlines, rental properties collect rent. There is no applause for stable yield, no viral posts about consistent dividend payments. Yet over long horizons, stability outpaces spectacle. The psychology of investing favors stimulation. Fast gains feel intelligent. Rapid shifts feel strategic. But speed introduces error. Error erodes capital. Boring assets reduce emotional interference. They are predictable, operational, underwhelming. Underwhelming assets rarely inspire impulsive decisions, and emotional restraint is an edge. Owning something dull means you are less likely to overreact, less likely to chase, less likely to panic. Boring ownership fosters patience. Patience fosters compounding. The loudest wealth stories often involve risk spikes. The quietest involve infrastructure. One is dramatic, the other is durable. Durability wins over time. Consider this. Every city depends on power, water, waste management, transportation. These systems operate regardless of market sentiment. They generate revenue regardless of trends. Owning pieces of necessity changes your relationship with volatility. Instead of betting on movement, you collect from function. Function is constant. Excitement fluctuates. Infrastructure persists. And persistence compounds. The quiet advantage of owning boring things is simple. They don't demand attention. They demand patience. And patience is rarely celebrated. But over decades, patience accumulates more than hype. Wealth that lasts is rarely thrilling in the moment. It is repetitive, operational, predictable, which is why most people overlook it. They chase what feels dynamic while ignoring what functions steadily. And steady function is what builds dull wealth. Understanding this shifts your focus from chasing spikes to owning systems. Headlines reward movement. A stock surges 40%. A company triples in a year. A new sector disrupts an old one. Movement creates narrative. Cash flow creates stability. There is a difference between price and income. Price moves, income persists. A volatile asset can feel powerful when it rises, but if it does not generate cash, its value is dependent on someone else paying more later. Cash-flowing assets operate differently. They produce income regardless of daily price swings. Rent arrives monthly. Dividends are distributed quarterly. Infrastructure contracts pay annually. The return is not dependent on excitement. It is dependent on usage. Usage is more reliable than speculation. People need housing. Businesses need electricity. Cities need logistics. Necessity sustains revenue. Revenue sustains cash flow. Cash flow can be reinvested. Reinvestment compounds. Compounding prefers consistency over drama. If an asset pays you regularly, you do not need to guess its future popularity. You measure performance by yield, not by attention. Yield changes how you think. Instead of asking, "Will this spike?" you ask, "Will this continue?" Continuation builds stability. Stability builds scale. Headlines are short-term. Cash flow is structural. Short-term movements are amplified by media. Long-term payments are often ignored. Yet over decades, consistent yield outperforms erratic surges for most participants. Volatility attracts emotion. Cash flow attracts patience. Emotion leads to reaction. Patience leads to accumulation. Owning a boring, income-producing asset may not impress anyone, but it does not require constant decision-making. Decision fatigue is costly. Reaction is costly. Overtrading is costly. Cash flow reduces the need to act, and reduced action often preserves capital. Preserved capital compounds more effectively than capital repeatedly interrupted. Cash flow also changes risk perception. If an asset temporarily declines in price but continues paying income, your exposure remains productive. You are not relying solely on appreciation. That reduces psychological pressure. Psychological pressure leads to impulsive exits. Impulsive exits interrupt compounding. Cash-flowing assets anchor behavior. They create rhythm. Income in, reinvest, repeat. Repetition builds dull wealth. It is not thrilling, it is mechanical. Mechanical systems scale reliably. Cash flow does not need to trend. It needs to persist. Persistence over time creates quiet advantage. While others chase headlines, you accumulate payments. Payments reinvested. Reinvestment compounded. Over long horizons, that structure becomes significant. The quiet advantage of boring assets is not just stability, it is predictability. Predictability allows planning. Planning allows discipline. Discipline allows compounding to work uninterrupted. And uninterrupted compounding builds wealth that does not require attention to survive. In markets driven by noise, cash flow is signal, and signal endures longer than hype. If this made sense to you, you already understand more than most people do. This channel exists for that kind of awareness. Like the video, subscribe. Nothing here is accidental. Infrastructure is rarely exciting. Pipelines, transmission lines, data centers, warehouses, rental housing, none of it trends. But all of it functions. Function is the foundation of durability. Infrastructure serves necessity, not preference. People may cancel subscriptions. They rarely cancel electricity. They may rotate brands. They still need water. They may shift platforms. Goods still move through logistics networks. Necessity creates steady demand. Steady demand creates recurring revenue. Recurring revenue creates predictable cash flow. Predictable cash flow compounds quietly. A warehouse does not care about market narratives. It cares about occupancy. A rental property does not care about hype cycles. It cares about tenants. A utility does not depend on sentiment. It depends on usage. Usage is structural. Structural demand reduces volatility in revenue streams. Revenue stability reduces behavioral error. Behavioral error is one of the largest destroyers of capital. Infrastructure assets often grow slowly, but slow growth sustained over decades becomes significant. A steady 4 to 8% return reinvested consistently outpaces dramatic spikes that collapse. The key variable is duration. Infrastructure assets are built for long time horizons, 20-year contracts, 30-year concessions, multi-decade depreciation schedules. Their structure assumes longevity. Longevity aligns with compounding. Short-term traders look for acceleration. Infrastructure investors look for continuity. Continuity builds wealth without spectacle. The market celebrates innovation. It depends on infrastructure. Every disruptive company still needs power, transportation, warehousing, connectivity. Infrastructure sits beneath trends. Trends rotate. Infrastructure remains. Owning underlying systems creates insulation from narrative shifts. If technology changes, power is still required. If consumer behavior evolves, goods still require storage and movement. Necessity does not disappear. The quiet advantage is not just stability, it is resilience. Resilient assets survive cycles. Survival allows compounding to continue uninterrupted. Interruption is expensive. If an asset collapses, compounding resets. If an asset persists, compounding continues. Infrastructure minimizes reset risk. Reset risk is rarely discussed, but it defines long-term outcomes. The fewer times your capital resets to zero, the more time can do its work. Infrastructure assets are rarely wiped out overnight. They may fluctuate. They may underperform temporarily, but their underlying necessity anchors value. Anchored value supports patient capital. Patient capital builds dull wealth. It is not dramatic, it is not viral, but it is durable. Infrastructure wins not because it excites, but because it endures. And endurance compounds. Boring assets do something unusual. They reduce stimulation. No dramatic price swings, no constant headlines, no urgent notifications. Less stimulation creates distance. Distance creates clarity. Most financial mistakes are emotional. Buying into momentum, selling into fear, chasing narrative, reacting to volatility. Exciting assets amplify emotion. They demand attention. Attention invites interference. Interference interrupts compounding. When you own something dull, a utility ETF, a rental property, a logistics REIT, there is less temptation to act constantly. The asset does not beg for reaction. It operates. Operation builds income. Income builds reinvestment. Reinvestment builds scale. Boring ownership removes the illusion of urgency. You are less likely to refresh prices every hour, less likely to compare short-term returns, less likely to panic. Patience is easier when nothing dramatic is happening. Drama invites ego. Ego invites error. In speculative environments, identity attaches to outcome. Wins feel personal. Losses feel threatening. Threat triggers reaction. Reaction disrupts process. Boring assets rarely threaten identity. They rarely promise brilliance. They simply perform. This detachment becomes an edge, because markets reward consistency more than intensity. If an asset yields steady cash flow and modest growth, your role is simple. Hold, reinvest, repeat. Simplicity reduces decision fatigue. Decision fatigue reduces mistakes. Mistakes compound negatively. Avoiding large errors often matters more than capturing every spike. Excitement increases variance. Variance increases risk of misjudgment. Dull wealth narrows variance. Narrow variance stabilizes outcomes. This stability compounds psychologically as well as financially. You become less reactive, less dependent on external validation, less tempted by sudden narratives. Emotional neutrality is powerful. When you are not emotionally attached to volatility, you allow time to work uninterrupted. And uninterrupted time is the core advantage. Boring assets protect you from yourself. They do not promise speed. They promise continuity. Continuity is the foundation of compounding. While others chase spikes, you accumulate quietly. Quiet accumulation rarely draws attention, but it builds stability, and stability, sustained long enough, becomes significant. The quiet advantage is not just financial, it is behavioral. Owning boring things reduces the emotional noise that destroys wealth, and silence allows compounding to continue. Most people are taught to look for excitement, fast growth, breakout potential, the next disruption. Excitement feels intelligent, movement feels productive. But wealth rarely depends on adrenaline. It depends on repetition. The strategic shift is subtle. You stop asking, what could explode, and start asking, what will still be functioning in 20 years? That question filters differently. You begin prioritizing cash flow over headlines, stability over speculation, usage over popularity. You look at assets that serve necessity: power grids, transportation networks, data infrastructure, rental housing, broad market index funds. They don't promise overnight transformation. They promise durability. Durability gives time room to work. When you own a system that produces recurring income, you reduce dependency on prediction. You don't need to guess the next trend. You need to ensure the system keeps functioning. Functionality compounds. Compounding rewards patience more than brilliance. This is the quiet advantage. While others rotate through narratives, you hold exposure to necessity. While volatility spikes, cash flow continues. The returns may look modest year to year, but modest returns reinvested consistently become significant over decades. Boring wealth does not impress in the short term. It dominates in the long term. And because it lacks spectacle, it attracts less competition. Less competition often means steadier pricing. Steady pricing reduces behavioral error. Over time, your portfolio becomes less reactive, less emotional, more mechanical. Mechanical systems scale reliably. You stop chasing moments. You start owning processes. That shift is quiet, but it changes trajectory. Because once you anchor your capital to systems that endure, you stop depending on excitement to create returns, and you begin depending on continuity. Continuity compounds. If this changed how you think about wealth and excitement, subscribe for more breakdowns of how durable systems build quiet advantage. Like this, if you prefer stability over spectacle. This channel isn't here to sell excitement. It's here to clarify structure. And structure is rarely flashy. But it lasts. You sleep. The system doesn't. While you close your eyes, currencies trade, futures move, interest accrues, servers process transactions across time zones. There is no silence in capital markets, only rotation. New York closes, Asia opens, Europe overlaps. Liquidity passes from one exchange to another. Money does not wait for you to wake up. Dividends accumulate overnight. Real estate appreciates quietly. Debt compounds in the dark. Compound interest does not require consciousness. It requires time. And time does not pause. Most people think wealth is earned only when they are active, working, negotiating, executing. But ownership behaves differently. Labor stops when you stop. Capital does not. This is the first asymmetry. You trade hours. Assets operate on cycles. Factories produce. Algorithms rebalance. Rental agreements generate income. Licenses collect royalties, even while you rest. The illusion is that money is tied to effort, that wealth sleeps when you sleep. It doesn't. It migrates. It reallocates. It compounds. When markets correct overnight, when rates shift while you're offline, when global events reprice assets before morning, you wake up to outcomes you did not witness, because the system never paused for your awareness. Time is neutral, but structures built on time are not. If you own productive assets, time works in your favor. If you rely solely on labor, time works in segments, shift to shift, hour to hour. Capital compounds continuously, labor compounds conditionally, and that difference expands quietly over years. This is not motivational, it is mechanical. The system is always pricing risk, allocating resources, adjusting valuations, whether you are watching or not. You rest, markets rotate. You pause, capital reallocates. There is no closing bell for ownership, only for participation. Money does not move in business hours. It circulates continuously. Foreign exchange markets operate 24 hours a day. When New York closes, Tokyo opens. When Tokyo closes, London overlaps. There is no global pause, only rotation. Capital hands off from one time zone to another, like electricity through a grid. Interest accrues by the second, not by the day. Every outstanding loan grows continuously. Mortgages, corporate bonds, sovereign debt. Debt compounds in the dark, whether you are awake or not. Clearinghouses settle obligations overnight. Derivatives reprice based on futures markets. Risk models adjust exposure automatically. Large institutions don't wait for morning. They operate through infrastructure, data centers, automated liquidity systems, high-frequency execution engines. When economic data is released overseas, currencies move immediately. Bond yields adjust instantly. Equity futures react before domestic markets open. By the time you check a headline, the repricing has already happened. You are observing an outcome, not a live event. This is why markets gap at the open, why portfolios look different at 9:30 a.m. than they did at 4 p.m., because capital flowed while participation paused. Retail investors sleep. Institutional systems do not. Consider dividends. They accrue automatically. Real estate. Rental income clears through digital systems. Royalties distribute based on usage data. Index funds rebalance according to mandate. None of this requires your presence. Ownership activates time itself. Labor requires awareness. Capital requires structure. You must show up to earn. Assets do not. This is not about hustle. It's about architecture. Modern finance is layered. Retail markets have visible hours. Institutional capital operates in extended sessions. Global markets overlap across continents. Derivatives anticipate future price movement before spot markets react. Even while you rest, expectations are being priced. Risk is being redistributed. Liquidity is migrating. Central banks announce policy changes at specific times, but currency markets react globally within seconds. Bond yields shift overnight. Commodity futures incorporate geopolitical tension before morning news cycles catch up. You wake into a world that has already been repriced. And this continuous repricing does something subtle. It amplifies compounding. Small movements stack. Fractional percentage changes accumulate. Leverage magnifies incremental shifts. Time zones don't slow the process. They extend it. The system never fully idles. It rotates, it adjusts, it reallocates. Capital searches constantly for yield, for safety, for opportunity. Across borders, across currencies, across asset classes. You might experience your income in hourly increments, biweekly deposits, monthly pay cycles. Capital experiences itself in milliseconds, continuous accrual, uninterrupted adjustment. This is the second asymmetry. Your effort is conditional. Capital flow is continuous. And continuous systems outperform conditional ones over long horizons. When you stop working, income pauses. When you own productive assets, time keeps working. The system never sleeps. Only participants do. Most content talks at you. This one sits with you. If that difference stood out, if this felt real instead of loud, like the video, subscribe. This channel is built for people who notice patterns. The difference between conditional effort and continuous capital is not obvious in a week or a month. It becomes visible over years. If you are paid for time, your income resets daily. You begin at 0 each morning. You exchange hours. You receive compensation. The cycle restarts. There is no automatic carryover of momentum. Ownership behaves differently. Dividends reinvest. Equity appreciates. Debt amortizes. Rents increase. Royalties accumulate. Capital stacks, even when unattended. This is where the system quietly separates participants, not through intelligence, not through effort alone, but through structure. If your income depends entirely on presence, you are synchronized with your own energy. When you stop, income slows. When you pause, momentum fades. But if you own productive assets, momentum is embedded. Time compounds in your absence. Returns generate returns. Collateral expands. Opportunities multiply from prior gains. The system rewards continuity, and ownership creates continuity. Consider two individuals over 20 years. One earns well, spends responsibly, saves periodically. The other earns similarly but acquires assets early, reinvests consistently, uses moderate leverage tied to productivity. At first, the difference is small, incremental, barely visible. But compounding is not linear. It accelerates. Returns build on returns. Appreciation builds on appreciation. Debt shrinks in real terms under inflation. Assets reprice upward over time. Ownership begins to outpace labor structurally. Labor compounds through promotion. Capital compounds through mathematics. Promotion depends on opportunity. Mathematics depends on time. And time never sleeps. While one person rests from work, their portfolio may still fluctuate. Their rental property still accrues equity. Their business still processes transactions. Meanwhile, wage income pauses until the next shift. This creates a widening effect that feels mysterious to those who only see effort. They work harder, they increase hours, they chase incremental raises. But incremental raises struggle to match exponential compounding. The system is not designed to reward motion alone. It rewards positioned ownership inside continuous flow. And because capital operates across time zones, across markets, across cycles, its continuity multiplies beyond individual capacity. You have biological limits. Capital does not. You need rest. Assets do not. You age. Equity structures can endure for generations. This is why wealth gaps often widen quietly, not because someone worked 0 hours, but because someone owned systems that never paused. Over decades, the difference compounds, not dramatically at first, but relentlessly. The system never sleeps, and if you are only trading time within it, you are operating on partial participation. Continuous systems overpower conditional ones, not morally, mechanically. The worker stops, the asset continues. The shift ends, the structure doesn't. And over long horizons, continuity wins. If the system never sleeps, then effort alone will never be enough. Not because effort lacks value, but because effort is intermittent. You operate in shifts. Capital operates in cycles. You measure weeks. Markets measure milliseconds. The gap is not emotional. It is structural. Most people try to compete inside the system using only labor. They increase hours, add side income, stack credentials, all rational decisions, but still conditional. When you stop showing up, income slows. When you pause, momentum resets. When you burn out, production halts. Your body enforces limits. Capital does not have one. Ownership changes the relationship. When you own productive assets, time becomes an ally. Dividends accrue without attention. Equity grows quietly. Debt amortizes while you rest. Rents clear digitally. Businesses transact automatically. Momentum persists in your absence. This is not about escaping work. It is about shifting dependency. Labor can build capital, but capital sustains itself. The system is designed around continuity. Debt compounds continuously. Markets price continuously. Liquidity reallocates continuously. So the strategic question becomes simple. Are you positioned inside continuity or only inside effort? If all income depends on your hours, you are synchronized with your own exhaustion. If part of your income depends on ownership, you are synchronized with time itself. You cannot slow the system. You cannot pause global capital flow. You cannot convince markets to rest. But you can decide whether you participate passively or structurally. That doesn't require speculation. It requires allocation, ownership of productive assets, long-term positioning, exposure to compounding structures. Small positions sustained over long horizons outperform reactive bursts of effort because continuity outlasts intensity. The system never sleeps. It rotates, reprices, reallocates, compounds. And over decades, continuity outperforms interruption. The worker rests, the structure persists, the shift ends, the cycle continues. If this changed how you see time inside the financial system, subscribe. Like this if it clarified something. We don't chase headlines. We study structures, because structures compound. Debt is often described as a tool, neutral, flexible, available to anyone who qualifies. You're told it can help you build credit, buy a home, start a business, go to school. All true, but incomplete. Debt is not just a personal obligation, it is a financial instrument, and every financial instrument exists inside a structure. When you borrow money, you enter a contract. You receive capital today, you promise repayment tomorrow, with interest. Interest is the key variable. Interest is the price of time. It is the premium paid for accessing capital you do not yet own. From your perspective, debt feels like relief, immediate liquidity, immediate access, immediate progress. From the lender's perspective, debt is a predictable stream of future cash flow. Your monthly payment is their recurring revenue. Your interest payments are their margin. That doesn't make lenders villains. It makes debt directional. Money flows somewhere. It never disappears. When you pay interest, capital moves upward toward the institution that provided the loan. Over time, this becomes significant. A mortgage can double the effective price of a home over decades. Student loans can extend repayment well beyond the period of education. Credit cards can compound aggressively if balances are maintained. Each payment contains two parts: principal, which reduces your obligation; interest, which compensates the lender. Interest is the reward for owning capital. Ownership of capital is power, because capital can be deployed repeatedly. If a bank lends $300,000 for a mortgage, it does not simply lose that money. It creates an asset on its balance sheet, a performing loan, a predictable stream of payments. Those payments are valued, packaged, sometimes resold. Debt becomes an asset for the lender. Your liability is someone else's investment. This is the part rarely discussed clearly. Debt is framed as a personal milestone: buying a house, financing a car, consolidating balances. But structurally, it is a revenue contract. You commit future labor to repay present access. That commitment is powerful because it links your time to someone else's return. Every month, part of your effort transfers upward, not maliciously, mechanically. Multiply that across millions of borrowers: mortgages, auto loans, student loans, credit balances. The result is a massive, predictable stream of interest flowing into financial institutions. This is why debt markets are stable pillars of the financial system. They generate recurring income. They price risk. They distribute capital. Debt is not chaos. It is structured flow. And structured flow benefits the owner of capital first. This does not mean you should never use debt. It means you should understand its direction. When you borrow for consumption, the asset often depreciates. When you borrow for appreciation, the asset may offset the interest cost. That distinction matters. But before even reaching that nuance, you must recognize something foundational. Debt is not neutral. It is a contract where time, risk, and capital are priced. And in that contract, the lender is positioned to receive predictable returns. The borrower receives access. The lender receives compounding. Access feels empowering in the short term. Compounding dominates in the long term. If you only see debt as a personal burden, you miss the larger architecture. Debt is a channel through which money flows upward, steadily. Understanding that is not about resentment, it's about clarity. Because once you see who benefits structurally, you begin to ask a different question. How do you move from being primarily the payer of interest to occasionally being the receiver of it? When you make a debt payment, it feels routine, a transfer, a withdrawal, a monthly obligation cleared. But structurally, that payment is income, not for you, for the institution that owns your loan. Banks do not primarily sell money, they sell access to money. Access today in exchange for interest tomorrow. Interest is not arbitrary. It is priced risk, priced time, priced probability. If a borrower is stable, interest is lower. If risk increases, interest rises. But regardless of rate, interest accumulates. And accumulation across millions of borrowers becomes predictable revenue. Banks operate on scale. One mortgage is modest. 1 million mortgages is a structured cash engine. Each payment flows into the institution's balance sheet. Each performing loan strengthens its asset base. Loans are assets to banks. Your debt appears on their books as value. Your obligation increases their leverage. Banks can also bundle loans. Mortgages become mortgage-backed securities. Debt becomes financial products. Those products are sold to investors. Now the interest flows not just to banks, but to funds, asset managers, and institutional holders. Retirement funds hold debt instruments. Insurance companies hold debt instruments. Investment firms hold debt instruments. The interest you pay can circulate through multiple layers of capital markets. This is why debt markets are foundational. They generate steady yield. Yield is attractive because it is predictable. Equities fluctuate. Commodities move. Debt contracts promise defined payments. Predictability attracts capital. Capital seeks stability. Debt provides it. When you commit to 30 years of mortgage payments, you are creating a 30-year cash flow stream. That stream can be modeled, valued, sold, leveraged. It becomes part of a larger financial machine. This is not secretive, it's structural. Debt markets are transparent pillars of modern finance. Governments issue bonds, corporations issue bonds, individuals take loans. All of it generates interest. Interest is the reward for holding capital instead of spending it. If you have surplus capital, you can earn interest. If you lack capital, you pay it. That asymmetry is quiet but powerful. The lender's money works without labor. The borrower's labor services the money. Time flows differently depending on which side you stand. On the lending side, time increases return. On the borrowing side, time increases cost. This is why financial institutions value duration. Longer loan terms, longer payment schedules, more months of predictable yield. And this is why they compete for deposits. Deposits fund loans. Loans generate interest. Interest generates profit. The cycle sustains itself. Most people only see one side of this equation: their payment, their balance, their interest rate. They do not see the layered beneficiaries: banks, shareholders, bondholders, institutional investors, all participating in the flow. Debt is not just between you and a lender. It is integrated into a capital system. Your monthly payment may be small in isolation, but aggregated across millions, it becomes structural revenue. That revenue funds dividends, executive compensation, investor returns, expansion of lending capacity. The system is not built to collapse under debt. It is built to profit from it. Understanding this is not about anger. It is about orientation. If interest is flowing somewhere, you should know where. When you borrow, you gain access. When institutions lend, they gain yield. Yield compounds. Access expires. And the side that compounds ultimately scales. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. Interest compounds. That sentence applies to both sides of debt, but it does not benefit both sides equally. This is where asymmetry begins. When you borrow at 6%, 12%, or 20%, that rate compounds against you. If you carry a balance, interest is calculated on the remaining principal. If the balance persists, the cost grows. Time increases what you owe. Now look at the other side. When capital is invested into performing loans, interest compounds in favor of the holder. Time increases what they earn. Same mechanism, opposite direction. A borrower experiences time as pressure. A lender experiences time as yield. That difference is structural. If you pay off a loan early, you reduce total interest. If you extend the term, you increase it. From your perspective, speed reduces cost. From the lender's perspective, duration increases return. That is asymmetry. It becomes more pronounced with high-interest debt, credit cards at double-digit rates, personal loans at elevated risk premiums, subprime lending at even higher cost. When balances revolve, interest compounds aggressively, and because minimum payments are often structured to prioritize interest first, principal reduction is slow. This keeps the revenue stream intact longer. The structure is designed for sustainability, for the lender, not collapse, not chaos, sustainability. As long as borrowers can continue making payments, the system functions smoothly. And because debt is widespread, the interest collected is distributed across financial markets. Bondholders receive yield. Shareholders receive dividends. Institutions reinvest profits into more lending. Capital feeds itself. Meanwhile, on the borrower side, interest reduces optionality. If a significant portion of income is allocated to servicing debt, less remains for ownership, less remains for investing, less remains for compounding in your favor. This is the deeper asymmetry. You are paying compounding while lacking exposure to receiving it. Two people can work equally hard. One allocates surplus into interest payments. The other allocates surplus into interest-bearing assets. Over time, the divergence is significant because compounding is exponential, and exponential curves widen quietly. Interest is neutral in mathematics. It is not neutral in positioning. The formula does not care who benefits. Position determines direction. If you stand primarily as borrower, time works against you. If you stand primarily as capital holder, time works for you. Most people oscillate between the two. They borrow for consumption, they save minimally, they invest sporadically. But if borrowing dominates investing, the asymmetry tilts. This is why financial institutions prioritize asset ownership. They hold capital, they extend loans, they collect yield. They are positioned on the receiving side of compounding. And borrowers, often without realizing it, are positioned on the paying side. Compounding is powerful, but only if it works in your direction. Understanding interest asymmetry changes how you view debt, not as evil, not as forbidden, but as directional. You begin asking, is this debt creating access to an appreciating asset, or is it committing future labor to a depreciating one? Because if the asset appreciates faster than the interest rate, the asymmetry narrows. If it does not, the asymmetry widens. And over decades, widening gaps define wealth distribution. Interest is not the enemy. Ignorance of direction is. If you understand who benefits from compounding, you begin to question which side you occupy most often. And that question changes how you engage with debt entirely. When you zoom out, debt is not just a personal contract. It is a channel through which capital flows in a consistent direction, from borrower to capital holder. Individually, the transfer feels small, a few $100s in interest, a monthly payment cleared, a balance slightly reduced. Aggregated across millions, it becomes structural movement. Mortgage payments across a country, auto loan payments across a generation, student loan payments across decades. Those flows don't disappear, they accumulate. Interest paid becomes retained earnings. Retained earnings strengthen balance sheets. Stronger balance sheets increase lending capacity. Increased lending capacity expands the system further. This is how debt scales. It is not chaotic extraction. It is organized transfer. Consider housing. A homebuyer borrows capital to purchase property. Over 30 years, they repay principal plus interest. Principal builds equity for the borrower. Interest builds return for the lender. If the home appreciates significantly, the borrower benefits. If it stagnates, the lender still collects yield. The lender's position is structured to be compensated first. Debt prioritizes the capital provider. Even in default scenarios, assets are repossessed. Collateral exists to protect capital. Risk is priced into the rate. Loss is distributed across portfolios. But the flow direction remains clear. The majority of households allocate a portion of lifetime income to servicing debt. That income originates from labor. It transfers upward into capital markets. Over decades, this reinforces ownership concentration. Those who hold diversified debt instruments receive steady returns. Those who service them reduce surplus. Reduced surplus delays ownership entry. Delayed ownership limits compounding exposure. This is where debt becomes a wealth transfer mechanism, not through conspiracy, through structure. If a significant share of income across society is committed to interest payments, and those payments accumulate within financial institutions, capital pools deepen at the top of the structure. Those pools can then be reinvested into more loans, into equity positions, into appreciating assets. Capital feeds capital. Meanwhile, households servicing debt operate with thinner margin. Thin margin reduces flexibility. Reduced flexibility limits asset acquisition. The cycle sustains itself. Debt is not random. It is directional infrastructure. It channels time-based income into capital-based return. If you remain primarily on the servicing side, your financial life revolves around payments. If you transition occasionally to the holding side, your financial life begins to include receipts. Receipts from bonds, dividends from institutions that lend, yield from capital deployed. The same mechanism that extracts from one side pays the other. This is the asymmetry scaled across society. Understanding it changes how you interpret your monthly payment. It is not just a bill. It is participation in a larger capital transfer system. That does not mean reject debt entirely. It means recognize its structural role. Because once you understand flow, you can start asking a more strategic question. How often are you primarily transferring wealth, and how often are you positioned to receive it? Debt is not inherently destructive. It is directional, and direction determines outcome. There are two broad categories: productive debt, extractive debt. Productive debt acquires an asset that has the potential to appreciate or generate income. A business loan that increases revenue, a property that produces rental cash flow, capital deployed into something that can outpace the interest rate. Extractive debt funds consumption that depreciates, vehicles that lose value, lifestyle expansion, short-term gratification financed long-term. Both require repayment. Only one has the potential to offset its cost. If interest compounds against you, the asset attached to that debt must compound faster. Otherwise, the asymmetry remains. This is the shift most people never make. They see debt as either normal or dangerous. Rarely do they evaluate it as strategic. The question is not, is debt good or bad? The question is, who benefits from the compounding? If the lender benefits more than you, the debt is extractive. If the asset benefits you more than the lender, the debt becomes leverage. That distinction changes behavior. You become slower to finance consumption, more deliberate about financing acquisition. You stop viewing credit as convenience. You start viewing it as capital with a cost. Every interest rate becomes a hurdle. Can the asset clear it? Can it exceed it? If not, you are committing future labor to someone else's yield. Understanding this does not require resentment. It requires positioning. Financial institutions will continue to lend. Investors will continue to collect yield. Debt markets will continue to function. The structure will not change because you understand it, but your relationship to it will. You can remain primarily a payer of interest or gradually become a receiver of it. Even small shifts matter. Owning dividend-paying assets, holding fixed-income instruments, participating in equity positions. Exposure changes direction. You may still use debt, but you use it intentionally, with clear awareness of asymmetry. Because once you see debt as a wealth transfer channel, you stop walking into it blindly. If this clarified who actually benefits from your debt, subscribe for more breakdowns of how capital really flows. Like this if it changed how you see interest and leverage. This channel isn't here to scare you away from systems. It's here to help you understand them. And once you understand the flow, you can decide which side of it you want to stand on. Fatigue is no longer an exception. It's baseline. Most people wake up tired, move through the day tired, fall asleep distracted, and repeat. Exhaustion has been normalized. Long work hours, commutes, notifications, constant connectivity. There is no clean mental boundary anymore. Work follows you home. News follows you to bed. Comparison follows you everywhere. Rest is fragmented. Attention is divided. Silence is rare. This isn't dramatic. It's ordinary. And that's the key. When something becomes ordinary, it stops being questioned. Fatigue used to signal imbalance. Now it signals participation. If you are busy, you are productive. If you are exhausted, you are committed. The narrative rewards depletion. But exhaustion has consequences. Cognitive energy declines. Long-term thinking weakens. Impulse control softens. You default to convenience. Convenience is fast. Fast decisions are rarely strategic. When energy is low, survival dominates. Survival focuses on today, not 10 years from now. Strategic thinking requires surplus energy, energy to step back, energy to evaluate structure, energy to question incentives. Exhaustion removes that surplus. You don't analyze systems when you are depleted. You manage tasks. You don't redesign your financial trajectory. You clear your inbox. You don't evaluate leverage. You make minimum payments. This is not personal weakness. It is neurological reality. A tired brain conserves resources. It seeks simplicity, immediate relief, predictable patterns. And predictable patterns often mean compliance. Compliance with routines, compliance with spending habits, compliance with whatever reduces friction. Fatigue narrows focus. Narrow focus limits perspective. When perspective narrows, systems remain invisible. You experience pressure. You don't examine architecture. You feel stress. You don't analyze incentives. That distinction matters. A well-rested mind asks structural questions. Why is this structured this way? Who benefits from this design? Is there leverage here? A tired mind asks, what do I need to finish today? And then it stops. Exhaustion doesn't silence you. It redirects you from long-term positioning to short-term management. Management keeps the machine running. Positioning changes your role inside it. Modern life doesn't require conspiracy to produce fatigue. It requires constant input. Screens, noise, deadlines, financial pressure. Each layer drains attention. Attention is finite. Energy is finite. And when both are depleted, you default to what is familiar. Familiar patterns rarely disrupt structure. This is the quiet reality. A tired population does not revolt. It copes. It optimizes survival, not leverage. Exhaustion becomes the operating environment. And when fatigue is default, strategic thinking becomes rare. Attention is not just personal. It is economic. Every notification competes for it. Every platform monetizes it. Every headline is engineered to capture it. Your attention is revenue for someone. Advertising models depend on it. Engagement metrics depend on it. Algorithmic systems optimize for it. The longer you scroll, the more valuable you become to the platform. But your cognitive energy decreases. That asymmetry matters. Attention directs thought. Thought directs behavior. Behavior directs capital. If your attention is fragmented, your behavior becomes reactive. Reactive behavior rarely builds leverage. It consumes. It responds. It reacts to stimuli instead of designing systems. When attention is scattered across dozens of inputs, long-term planning weakens. You focus on the loudest signal, not the most important one. Markets move loudly, media reacts instantly, social comparison updates continuously. None of it requires depth. Depth requires uninterrupted focus. Uninterrupted focus is rare in environments built for interruption. Distraction is profitable because distracted individuals do not analyze structure. They follow patterns. They respond to urgency. They purchase convenience. They default to whatever reduces friction. Convenience is often monetized. Subscriptions auto-renew. Payments are automated. Algorithms decide what you see next. The less attention you allocate deliberately, the more you operate inside preset systems. Preset systems are efficient. Efficiency benefits the system operator. It does not necessarily benefit the participant equally. Consider how rarely people sit in silence without input. No screen, no music, no feed. Silence creates space. Space creates reflection. Reflection creates strategic awareness. Strategic awareness challenges default behavior. Default behavior sustains economic flow. This is not malicious, it is incentive-driven. If platforms generate revenue from engagement, they optimize for engagement. If financial institutions profit from predictable spending patterns, they benefit from consistent behavior. Attention fragmentation supports predictability. Predictability supports revenue modeling. A focused individual questions structure. A distracted individual participates in it. Participation sustains systems. Questioning redesigns them. Redesign requires mental bandwidth. Bandwidth requires energy. Energy requires rest and intentional allocation. When attention is constantly extracted, energy declines. Declining energy reduces resistance. Resistance requires clarity. Clarity requires focus. Focus requires boundaries. Boundaries are difficult in always-on environments, so attention becomes fragmented. Fragmentation becomes fatigue. Fatigue becomes compliance. This is the quiet loop. Attention extracted, energy depleted, agency reduced. And when agency reduces, strategic positioning becomes rare. Understanding this shifts how you see distraction. It is not just entertainment. It is economic infrastructure. And the more aware you are of where your attention goes, the more control you regain over where your capital follows. Before this continues, if you felt seen instead of sold to, that's the entire point of Relentless Wealth. Like the video, subscribe. We're just getting started. Fatigue changes behavior. Not dramatically, subtly. When you are tired, you don't stop functioning, you narrow. Energy declines. Decision quality declines with it. Cognitive science is clear on this. Low mental energy reduces executive function. Executive function governs planning, impulse control, long-term reasoning. When it weakens, you default to the easiest option. Convenience, familiarity, automation. Convenience is often monetized. Prepackaged food, one-click purchases, auto-renew subscriptions, financing at checkout. Each reduces friction. Each reduces thought. And reduced thought increases compliance. Compliance is not forced. It is chosen through exhaustion. You agree because it is easier than evaluating alternatives. When energy is high, you analyze, you compare options, you question fees, you negotiate terms. When energy is low, you accept defaults. Defaults are designed by institutions. Institutions design defaults to optimize revenue and efficiency. The path of least resistance rarely challenges structure. It sustains it. Fatigue also reduces risk tolerance. You avoid change. You avoid complexity. You avoid uncertainty, even if that uncertainty contains upside. Tired people prefer predictability over growth. Predictability feels safe. Safety reduces cognitive load. So you remain in roles you've outgrown, maintain subscriptions you don't evaluate, carry balances you intend to pay later. Not because you lack intelligence, because you lack surplus energy. Agency requires energy. Agency means choosing deliberately, resisting impulse, designing structure. Design requires bandwidth. Bandwidth requires rest. In chronically fatigued environments, bandwidth shrinks. And when bandwidth shrinks, you stop building. You start maintaining. Maintenance keeps life stable. It rarely changes trajectory. A tired population manages. A clear population redesigns. Management sustains systems. Redesign alters them. Fatigue makes redesign unlikely. This is not dramatic. It is behavioral economics. When decision fatigue increases, individuals rely on heuristics. Heuristics simplify. Simplification benefits preset pathways. Preset pathways are optimized for efficiency, often for institutions first. Agency declines quietly. You don't feel controlled. You feel busy. You don't feel restricted. You feel exhausted. Exhaustion masks limitation, because when you are tired, survival feels like enough. And survival does not require structural awareness. It requires compliance with what is already in place. The reduction of agency is not loud. It is cumulative. 1,000 small defaults, 1,000 small conveniences, 1,000 small decisions made without scrutiny. Over years, those decisions shape financial trajectory. And trajectory, once set, becomes momentum. Momentum is difficult to redirect when energy is low. Fatigue does not remove your intelligence. It reduces your ability to apply it strategically. No system needs to control you. It only needs you predictable. Predictability allows modeling. Modeling allows optimization. Optimization generates profit. When behavior becomes consistent, revenue becomes forecastable. Forecastable revenue supports valuation. Valuation supports capital expansion. This is how institutions scale. A population that spends consistently, borrows consistently, consumes consistently, creates stable cash flow for corporations and lenders. Stable cash flow attracts investors. Investors reward predictability with capital. Capital deepens the system. Now consider fatigue inside this structure. A tired individual does not redesign spending patterns often. They do not frequently renegotiate contracts. They do not constantly analyze fees. They maintain. Maintenance produces stability. Stability produces reliable revenue streams. From an institutional perspective, stability is efficient. From an individual perspective, stability can become stagnation. Economic systems reward participation. They do not necessarily reward self-examination. Self-examination disrupts patterns. Disruption creates volatility. Volatility complicates forecasting. Forecasting is essential for capital markets. If consumer behavior swings wildly, revenue projections fail. Investments become riskier. So systems evolve toward frictionless participation. Subscriptions renew automatically. Payments auto-deduct. Algorithms personalize offers. The less energy required to continue a pattern, the more durable that pattern becomes. Durable patterns benefit the operator of the system. Consider advertising. It does not require you to agree. It requires repetition. Repetition shapes familiarity. Familiarity shapes comfort. Comfort shapes purchase behavior. Fatigue lowers resistance to repetition. When you are mentally sharp, you question claims. When you are depleted, you accept convenience. That acceptance sustains economic flow. A distracted population consumes. A focused population evaluates. Evaluation slows systems. Consumption accelerates them. Acceleration increases growth metrics. Growth metrics increase market confidence. Confidence increases capital inflow. The loop continues. This is not a conspiracy. It is incentive alignment. Platforms are rewarded for engagement. Corporations are rewarded for revenue growth. Financial institutions are rewarded for lending volume. None of these incentives prioritize your cognitive clarity. Clarity is your responsibility, and clarity requires energy. Energy requires boundaries. Boundaries reduce exposure to constant input. Constant input sustains engagement metrics. Engagement metrics sustain valuation. The system does not need you broken. It needs you participating. Participation is easier when you are tired, because tired people do not redesign structure, they maintain it. Maintenance keeps revenue predictable. Predictability keeps capital stable. Stability benefits asset holders. This is the economic incentive. When you understand it, the narrative changes. Fatigue is not accidental. It is a byproduct of a system optimized for continuous engagement and consumption. And continuous engagement reduces the likelihood of structural repositioning. That is the quiet alignment. Not oppression, optimization. And optimization rarely prioritizes the participant's leverage over the operator's growth. If fatigue reduces agency, then energy restores it. This is not about sleeping more. It's about protecting cognitive bandwidth. Clarity is a strategic asset. Without clarity, you manage. With clarity, you reposition. Repositioning requires space. Space requires boundaries. Boundaries around attention, around media intake, around unnecessary commitments. Every notification competes for strategic thought. Every distraction fragments long-term focus. You cannot redesign your financial trajectory in fragments. You need uninterrupted thinking. Time to evaluate where your money flows, where your effort compounds, where your leverage exists or doesn't. That evaluation rarely happens in exhaustion. It happens in stillness. Stillness is not laziness. It is recalibration. When you reduce input, you increase awareness. When you increase awareness, you see structure. And when you see structure, you stop reacting blindly to it. You begin making decisions deliberately. Maybe you restructure debt. Maybe you reduce subscriptions. Maybe you redirect capital into ownership. None of those require drama. They require energy. Energy to think beyond the week, beyond the month, beyond the paycheck cycle. The system will continue to optimize for engagement. Platforms will continue to compete for attention. Corporations will continue to streamline consumption. You cannot stop that. But you can control where your attention rests. Attention directs behavior. Behavior directs capital. Capital determines leverage. If your attention is constantly extracted, your leverage remains stagnant. If your attention is intentional, your leverage begins to shift. The goal is not withdrawal from society, It is selective engagement. Selective engagement preserves energy. Energy supports strategic thought. Strategic thought changes trajectory. This is the quiet counterbalance. The system may function efficiently on exhaustion, but individuals build leverage on clarity. Clarity requires rest, requires silence, requires stepping back long enough to see the pattern. When you regain cognitive energy, you stop surviving structure. You start navigating it. If this helped you see fatigue differently, subscribe for more breakdowns of how structure shapes behavior. Like this if you prefer clarity over constant stimulation. This channel isn't here to create outrage. It's here to sharpen awareness. And awareness is the first form of leverage. Employment is built on a simple exchange: time for money. You show up, you perform, you deliver output. In return, you receive income. This arrangement feels stable, predictable, structured. But it contains a ceiling. Because time is finite. You have 24 hours in a day. A portion goes to sleep. A portion goes to obligations. What remains becomes marketable. And that remainder defines your earning bandwidth. No matter how skilled you become, no matter how efficient, no matter how valuable your output, your income remains tethered to presence. If you are not there, you are not paid. That is the foundational rule of employment. You can increase your hourly rate. You can negotiate a higher salary. You can earn promotions. But you are still trading segments of your life for compensation. When compensation stops, so does income. This is not exploitation. It is structure. Employers purchase time-bound productivity. They do not purchase your future compounding potential. Your hours generate value. That value often exceeds your compensation. The surplus becomes profit, and profit belongs to ownership. This is where the asymmetry begins. You sell time once. Ownership sells it repeatedly. When you complete a project, you are paid once. If the company scales, ownership continues to benefit. When you work overtime, your income increases temporarily. If the business expands market share, equity holders gain proportionally. Time for the employee is linear. Time for ownership is multiplicative. Linear growth feels productive. Multiplicative growth changes trajectories. In a time-for-money model, your ceiling is biological. You can only work so many hours. You can only sustain so much intensity. Even high-income employees face this constraint. 6 figures still require presence. 7 figures in salary still require accountability to hours and outcomes. The scale may change. The structure does not. When income depends entirely on your hours, time limits you. Every year you age, your energy fluctuates. Every life event interrupts earning capacity. Every pause reduces income. Time works against you because it erodes the one asset you are selling: your availability. This is why retirement planning exists, because eventually, time cannot be sold at the same rate. You are expected to accumulate enough savings to compensate for declining labor capacity. But that accumulation must occur inside the same time-bound model, which means you are racing against biology. Time is not neutral when your income is tied to it. Each hour worked is consumed. It cannot be reused. Each hour not worked is income not earned. This creates pressure to remain employed, pressure to remain productive, pressure to remain competitive. Because once you step out of the system, the income stops. And when income stops, financial momentum stalls. This is the reality most employees never articulate clearly. They feel the pressure, but they describe it as stress, burnout, work-life imbalance. Underneath all of it is a structural truth. When you sell time, you are trading something that cannot compound. Time moves forward regardless, and if income only arrives when time is actively exchanged, time becomes a limiting force. This does not mean employment is wrong. It means it is linear. And linear systems behave differently than compounding ones. Understanding that difference is the first shift, because once you see that your income is tethered to your hours, you begin asking a more important question. What happens to your earnings when you are not working? The promise of employment is progression. Work hard, gain experience, earn raises, and over time your income increases. But progression is not the same as transformation. A raise expands your bandwidth. It does not remove the ceiling. Because the structure remains fixed, you are still exchanging time for compensation. The rate improves. The model does not. Consider how salary growth typically works. Incremental percentage increases, promotions tied to responsibility, bonuses tied to performance metrics. Each improvement is tied to output. Each output requires presence. Even at high levels, executives remain time-bound. They may earn more per hour, but they still trade hours. This creates a hidden constraint. Income can grow only within the limits of the organization. Budgets cap raises. Market rates cap roles. Economic cycles cap expansion. No employee can outgrow the system that pays them. You can climb the ladder, but the ladder has a height. And that height is determined by ownership. Employees negotiate within structure. Owners shape structure. The ceiling becomes more visible over time. Early in a career, growth feels exponential. Entry-level to mid-level jumps feel significant. But as you advance, increments shrink relative to responsibility. Each raise requires more accountability, more oversight, more stress. And still, income remains dependent on continued participation. The fixed income model creates stability, but stability often masks limitation. You know what you will earn next month. You can forecast your salary. You can plan expenses. But you cannot scale infinitely. Scaling requires decoupling income from effort. In a fixed income structure, every dollar has a labor anchor. Every raise has a performance justification. Every bonus has a condition. There is no autonomous growth. Autonomy is the missing variable. Without autonomy, income is reactive. It responds to work. With autonomy, income can expand without proportional effort. The fixed income ceiling also creates psychological comfort. You know your lane. You know your range. Risk feels unnecessary. But comfort has a cost. Because while your income grows incrementally, assets in the broader economy may grow exponentially. Real estate appreciates, equities compound, businesses scale revenue. Those gains are not capped by salary bands. Fixed income grows in steps. Compounding assets grow in curves. Steps feel stable. Curves feel volatile. But over long periods, curves dominate. This is where time begins to work differently. As years pass, salary growth typically slows. Raises plateau. Opportunities narrow. Meanwhile, Assets held over the same years may accelerate because compounding rewards duration, not promotion cycles. The ceiling of fixed income becomes clearer with age. Your earning capacity may peak in mid-career. After that, maintaining position becomes priority. This is not failure, it is structural reality. Time amplifies limits in fixed systems. Time amplifies gains in compounding systems. If all of your income depends on a fixed role, you are contained within that role's economics. No matter how disciplined you are, no matter how skilled, that is the ceiling. Understanding this does not require abandoning employment. It requires recognizing its boundaries. Because once you see the boundary clearly, you begin to look beyond it. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. Time behaves differently depending on what you own. If you sell time, time is consumed. If you own assets, time is applied. That distinction is structural. In employment, each hour worked is exchanged once. You perform, you are paid, the transaction closes. That hour cannot generate income again. In ownership, the same hour can generate repeated return. If you own equity in a company, revenue growth benefits you whether you are working that day or not. If you hold appreciating assets, value can increase while you sleep. Time compounds ownership. Time depletes labor. Compounding is not dramatic in the short term. It is subtle, almost invisible. A 7% annual return does not feel transformative in year one, but over decades, it becomes exponential. This is the core asymmetry. When income is tied to employment, growth resets annually. You negotiate a raise. You earn incrementally more. The base increases slightly. But compounding builds on itself. Each year's growth becomes the foundation for the next. Ownership allows time to stack. Employment requires time to be resold. Stacking beats reselling. If you save $10,000 from salary and invest it, that capital begins to work independently. The next year, it may earn return. The year after, return on return. You did not work extra hours for that growth. Time did. Meanwhile, your salary remains dependent on renewed performance. If you stop working, salary pauses. If assets continue performing, income continues. This is why retirement accounts exist. They are an attempt to introduce compounding into a labor-based life. But often, exposure begins late, and contributions are constrained by fixed income. The earlier compounding begins, the stronger its effect. Time favors early ownership. Employees often delay ownership because surplus is limited. Expenses rise with income. Lifestyle expands, margin narrows. Compounding exposure remains small. Time cannot compound what is never deployed. That is the quiet cost of remaining purely time-bound. As years pass, energy fluctuates. Career mobility shifts. Market demand changes. Time erodes labor capacity, but it strengthens capital. This is why wealth concentration increases over long periods. Those with assets benefit from duration. Those without rely on continued effort. Effort does not stack the way capital does. You can work hard for 20 years. If income is consumed each year, nothing compounds. If capital is retained and invested, 20 years transforms modest sums into meaningful scale. Time is not neutral. It amplifies structure. In a labor model, time reinforces limits. In an ownership model, time reinforces growth. The same decades pass for everyone, but outcomes diverge based on exposure. This is not about abandoning employment. It is about recognizing that employment alone does not harness time fully. Without ownership, you experience time linearly. With ownership, you experience it exponentially. And exponential systems eventually outpace linear ones. That is not opinion. It is mathematics. If time is moving regardless, the question becomes simple. Is it consuming your earning power or multiplying it? The gap does not appear overnight. It widens gradually. At first, the employee and the owner may look similar. Both earn income, both pay expenses, both participate in the economy. But time treats them differently. The employee trades hours for compensation. The owner holds an asset that benefits from those hours, and from many others. When a company grows revenue, employees may receive raises. Owners receive equity appreciation. When productivity increases, salaries may adjust slightly. Profits can scale significantly. That difference compounds. An employee works 40 hours. They are paid once. The company generates revenue from those 40 hours and reinvests profit. That reinvestment expands operations. More employees, more output, more revenue. Ownership captures expansion. Labor captures wages. Over years, the asymmetry becomes visible. The employee's income grows stepwise. The owner's equity can grow multiplicatively. If the company's valuation doubles, equity holders benefit instantly. Employees must wait for review cycles. One model scales with performance. The other scales with valuation. Valuation can increase without proportional labor increase. This is where time becomes a dividing line. As decades pass, owners accumulate appreciating assets. Employees accumulate experience and savings. Savings do not compound at the same rate as equity ownership. Experience does not generate passive return. And because employees must continually trade time, their financial momentum pauses during interruptions, career gaps, health issues, economic downturns. Ownership often continues through those cycles. Assets do not call in sick. They fluctuate, but they persist. Meanwhile, employees must remain competitive, upskill, adapt, negotiate, all inside a linear model. This creates psychological pressure. You feel urgency to maximize earnings during peak years because you know time will eventually limit you. Owners feel urgency to deploy capital early because they know time will multiply it. Same years, different relationship to time. The asymmetry gap widens quietly, not through exploitation alone, through mathematics. Linear growth cannot outrun exponential growth over long horizons. If you remain exclusively in a linear structure, you remain inside its limits. Even high earners feel this eventually, because no salary scales infinitely. No career trajectory is guaranteed. But equity exposure can scale beyond individual effort. This is why wealth concentrates around ownership, not because employees lack effort, because ownership captures compounding. Time favors repetition. Assets repeat. Labor expires. That is the asymmetry. And once you see it clearly, you begin to question whether all of your time should be sold or whether some of it should be invested into ownership instead. Time will move regardless. The question is not whether it passes. The question is how it works for you. If all of your income depends on selling time, time limits you. If some of your income depends on ownership, time begins to assist you. This is not an argument against employment. Employment provides stability, cash flow, structure. But stability alone does not harness compounding. Compounding requires exposure. Exposure to assets that grow without your constant presence. Equity, index funds, rental property, businesses. Anything that can appreciate or generate return independent of your hours. The shift is not dramatic, it is gradual. You continue working, but you stop relying exclusively on wages. You redirect surplus into ownership. Instead of expanding lifestyle immediately, even modest ownership changes your relationship with time. Because now, part of your financial future is not tied to your calendar. You are no longer selling every hour. You are planting some of them. And planted time compounds. Over years, small allocations can become meaningful. The goal is not to quit your job tomorrow. It is to ensure that time does not work only against you. Because if time erodes your labor capacity and you have no compounding exposure, your financial momentum slows. But if time simultaneously grows assets, your momentum can accelerate even as effort stabilizes. That is the structural shift. Time is not the enemy. Selling it exclusively is the limitation. If this reframed how you see employment and ownership, subscribe for more breakdowns of how leverage changes outcomes. Like this if it helped you see time differently. This channel isn't here to criticize work. It's here to clarify structure. And once you understand how time behaves, you stop letting it limit you and start positioning it to multiply you.